Well, we are looking at a mixed story for stocks this morning. The U.S. stock story has been one of weakness in a week where we've already seen investors shifting out their expectation for rate cuts because of a resilient U.S. economy, which has forced a reassessment on stock valuations. Now you've got some geopolitical jitters in the air. We talked about the uncertainty in the Middle East today. And on top of that, we're now getting into earnings season. And from the banks that have reported in the U.S., a bit of a mixed result so far. The Canadian market, however, is trading higher this morning. Part of that is because those geopolitical concerns are helping oil. They are also helping gold, which has been enjoying a record run. Let's get some more on the market story now. Kathryn Rooney Vera is Chief Market Strategist with StoneX Group. Great to have you with us, Kathryn. You know, it's interesting. The S&P 500 has had this huge move over the last few months. We've started to see some cracks. We've come a little bit off the highs, but breaking that momentum story, I think, is what a lot of people are curious about right now. What do you think about the current levels for the U.S. stock market?
Well, the U.S. stock market, John, I think are pretty over their skis coming into this year. In the beginning of the year, we saw new all-time records, and that was based on the expectation of Fed cuts. That's unlikely to happen. I think max we get 2 cuts this year, and the market's repricing the risk of no Fed cuts at all this year. What we've seen is gold rally significantly as a result of being, the more defensive sector, and this has been our top call coming into this year at StoneX. Gold has outperformed every other asset class that we've liked, up about 16% since our long call. And I think powering gold from here is geopolitical risk, which is really hard to dictate. So at current levels, we think that gold is an opportunity to realize profits and reallocate that capital into cash and even other fixed income instruments.
Interesting. And does that mean then cash and fixed income trump, I don't know, other parts of the stock market that we haven't talked about?
Well, I think there's some opportunities in the more defensive sectors. I have been more cautious to the detriment of my recommendations of late because tech has done so incredibly well. But my expectation is that we are going to see a retracement. So far this year, we've seen an S&P that has done far better than historical averages that are comparable in this context would have pointed to. So I do think we should expect some consolidation, which means sideways movement in the S&P with downside volatility. And in that respect, I think we want to be looking at opportunities in the sectors that historically outperform in stagflationary scenarios or in uncertain times, which are defensive. That's staples, that's utilities, and that's healthcare.
All right.